Hey Bowtie Nation, Joseph Hogue here with an emergency video. Stocks shrugged off the US-Iran conflict on Monday, falling more than 1% to start the day before clawing it back into the green by day's end. But then reality set in, with the market down as much as 2.5% at one point yesterday, wiping out $690 billion in market value. Nation, this is going to get worse before it gets better, and the stocks that have won so far are not the ones you need to be looking at for your portfolio. I'll guide you through the news I'm following, how it's pointing to the stocks you need to buy, your investing playbook, and then show you one group of stocks that is going to surprise everyone. Let's get one thing straight first, though. War is hell. It's made by little men that have never pulled a trigger in their lives, that haven't seen their enemy die and haven't seen their friends die beside them. Fuck them and all their wars. Oh, while I would be just fine with all my shares of Lockheed Martin going to zero if there were no more wars, it's my job to make sure your portfolio is ready when one does happen and that you know how to invest. And to do that, I want to take you through some of the news I'm following and the stocks to watch, some of the stocks that have won lately, not the ones you want to be putting in your portfolio. Here we can scroll down here and see what some of the assets that have been doing well lately. Obviously, oil is up big, over 15% over the last couple of days. The Straits of Hormuz, people, the choke point there in the Persian Gulf, 20% of the world's oil flows through there. Iran has tried to bottleneck that, has tried to close it off. They haven't been successful closing that off in the past, but have been more successful lately. There's like 700 plus oil tankers that are stopped outside of the straits there. So they have basically stopped shipping through there, where 20% of the world's oil goes. Okay, so oil stocks obviously up. Gold has been up as investors rush to that safety. Defense stocks also, going to be talking about those later. Obvious winners here as people rush into these war-related stocks. Over the last 5 days and over the last month, really bleeding up to this, energy, the big winner. You can see here some of these oil stocks here. Targa Resources up 20%, Texas Pacific Land up 51%. A lot of the other oil explorers, the pipeline companies, APA Corporation up 17%. EOG, a lot of those natural gas, Williams Pipeline Corporation, the ConocoPhillips, all of those up double digits here just recently, just in the past month. But Nation, I do not want you chasing those oil stocks, okay? If this war does go on for longer, if the conflict does go into months and even towards the end of the year, that oil price is going to stay high. Those oil stocks are going to do well. But look at the price over the last year for oil. It has stayed mostly between $60 and $65, even dipping down into $55 there late last year, because the supply and demand fundamentals, the supply and demand for oil is horrible right now. Okay, it is going to keep oil down even with this Gulf War, this war in Iran. You can see it only took it up to $75 a barrel. It is up 1% here in the pre-market here on Wednesday. But if there is any good news on the war ending or opening up the Straits of Hormuz, the oil prices are going to be limited here, really $75, $80 a barrel, and with a big downside risk. That's because, again, the supply-demand fundamentals for oil really bad right now for that price. Really, over the last year, we can see here a billion-barrel oil glut forming at sea. This was at the end of 2025. We can see here those seaborne tankers. So all the tankers on the ocean that hold oil, up 25% over the average. Okay, average here 2016 to 2024, usually a little over 1.1 billion barrels of oil on seaborne tankers at any one point. That has ballooned to 1.4 billion barrels of oil. What a lot of this is that sanctioned oil from Venezuela, from Iran, oil that wasn't supposed to be sold on the global market, but was sitting there in tankers trying to find a buyer. Really kind of the black market for oil there has ballooned to 1.4 billion barrels. Now, what this means that all that supply, that pent up supply just sitting there on the sea looking for a buyer, it is going to find a buyer eventually, folks. Okay, oil is completely fungible. You can sell it anywhere. There are a lot of buyers for this seaborne oil, especially China. They will find a buyer, and that 25% above normal supply is going to keep the price down. That's why we saw the price so low over the last year, between $55 to $65 a barrel. We can scroll down here and see one of the big buyers over the last year. China has been buying, adding about 290,000 barrels of oil a day to its storage last year. That has ballooned China's stockpile. They aren't going to be buying that this year. Okay, they loaded up their stockpile last year with those 290,000 barrels of additional oil for their storage. That's going to take another buyer off the market. So what you're going to have this year is, especially with this price boom in on the Iran conflict, there you're going to have a lot of the supply still online. OPEC just announced it's going to increase its own production to cover a lot of the production loss from Iran. And the OPEC increasing its production going to boost that supply. Those seaborne barrels of oil, a lot of supply there. And now the fewer buying from China, you're going to have higher supply, lower demand from buyers, and that price is pretty much stuck. $75, $80 a barrel best case. Worst case, we do hear some good news on the conflict. Maybe that comes off the table and those oil prices crash lower. Now, instead of chasing those oil stocks that have boomed over the last couple of months, what you want to do, you want to look for better plays here. One of these in stocks and missile defense contractors, okay? Because this conflict is a race against time. Iran's inexpensive drones. We can scroll down here to where it talks about the drones. Okay, the depth of Iran's stockpile. So basically, we have a race against time with Iran's stockpile of drones, of its missiles that it's using across the region against the interceptor technology and the Patriot missile systems across the region available to shoot these things down. There is a very, very limited depth of supply for those interceptors and the Patriot missiles. Depth of Iran's stockpile here, which includes inexpensive drones that can produce at scale. Okay, so it's able to produce these drones, some of the missile technology at a massive scale. That's really testing the interceptor storage in the region. And you see the scale of that problem here with interceptor ammunition storage data here in the region. We see UAE alone says it's been targeted by 174 Iranian ballistic missiles, 8 cruise missiles, 689 drones just in the 3 days since, okay, it usually takes 2 to 3 interceptors to target and shoot down each of those attacks. So that alone, just in the UAE, it's upwards of 2,600 interceptors they need, well over the 1,000 that they have here. You can see here, as it just 1,000 of that those interceptor missiles, Patriot missiles, different types of interceptors to shoot down these drones, these missiles, these ballistic missiles. They just don't have it. Iran is estimated to have over 2,000 missiles alone and thousands of those drones. So these interceptor systems, the THAAD system produced by Lockheed Martin, that's ticker LMT, you're going to be looking at that, and the Patriot missile system by RTX, okay, ticker RTX, those are in extremely high demand. And not just for this war, but they're going to need to rebuild that storage afterwards. Here we can see shares of Lockheed Martin up 47% there over the last year, up 95% there in the last 5 years. A lot of that just here in the last year on that lead up into this Iran conflict. We can look here to analysis, see what kind of growth they're booking there. 5%, 4% growth in revenue expected this year and next. I think that goes a lot higher. Okay, again, they are the principal weapons manufacturer of this THAAD interceptor system. That is going to be used, all the munitions, all the storage is going to be used here over the next month, 2 months with this US-Iran conflict. And in the region, they are going to be getting some big orders to replenish that stockpile. Also looking here at RTX Corporation, ticker RTX, up 54% over the last year. Again, manufacturer of the Patriot missile system, one of the best interceptor systems there for those missiles, for those drones coming out of Iran. Here again, 5.4% sales growth, 6.6% expected next year. $93 billion to $99 billion in sales next year. I think, again, that gets a big upgrade. I think you see these numbers, these growth estimates boom here on Lockheed Martin as well as RTX as they see those orders come in to replenish that storage of interceptor technology. Another theme you want to be watching, and the stocks in it here. Iran is also one of the world's top sponsors of cyber threats, and at a time when the U.S. is least ready to deal with that. We can see here the leading U.S. cyber agency stretched thin here in that partial shutdown as the Iran hacking threat escalates. Here you can see on data from the European Repository of Cyber Incidents who's behind these cyber attacks. And these are mostly the political dimension, but really indicative of which states, which countries sponsor these cyber networks. And you see China and Russia, the two largest, over 11% of total there, but Iran, a close third, 5% there. Again, Iran going to be taking, or China and Russia going to be taking advantage of the fact that the U.S. cyber agency is behind, is stretched thin, especially with Iran increasing its own cyber attacks. They're going to increase their own threats, not just against the U.S. government, but against companies as well. Which brings me to one of my favorite cybersecurity stocks. Of course, all you out there in the nation know I've been a big believer in cybersecurity over the last few years. This is the one theme, the one budget line item in a company's IT spending that cannot be cut. Overall IT spending for cybersecurity forecast to grow about 12% annualized through 2030. I think that number is grossly underestimated. And now with this increase in cyber threats is going to be coming over the next few months, we're going to see an increase in cyber attacks and an increase in interest for these cybersecurity stocks. You got CrowdStrike Holdings actually just reported its earnings yesterday. Big increase in profits, 22% increase in profits or in revenue over the last year. CrowdStrike swung to a profit, an actual profit of 38 million 15 cents a share. That is above the loss of $86 million or 35 cents a share a year earlier. So big swing in profitability for the company. Revenue here, 23% up to $1.3 billion. Also annual recurring revenue up 24%. So revenue they can count on every single year, growing at 24% a year pace. Again, all you out there in the nation know cybersecurity is my one big theme to buy over this next few years in the space. Also like Palo Alto Networks, Fortinet, as well as Zscaler and Okta. So I own most of the big names in this. Okay, I think you don't necessarily have to go with any one particular name. I think all of these are good. Now I'm going to reveal the big 2026 surprise stocks next. The stocks I'm buying for that bigger picture, but if you found the analysis useful, please tap that like button so we can get this video out to more investors. And for the stocks to buy in that bigger picture, this is probably the hashtag surprised, not surprised moment. But folks, AI infrastructure stocks are still going to be your best returns for this year. And right now, it's your best opportunity to buy this dip as this Iran conflict really pushes a lot of these lower on top of the AI software fears we've had earlier this year. Now, since that October 29th peak, big tech names have been hit hard here as that S&P equal weight index basically kind of stays flat or up a little bit. We can see here the S&P 500 equal weight index, so the top 500 companies in the United States, the largest there on an equal weight basis. So taking out the size factor in those big tech companies is up just over 5% for the year. But you can see here Amazon, Nvidia, Meta, Broadcom, Microsoft, all the big AI tech players, all the big hyperscalers down 10% and more. Microsoft down more than 20% from its about 60% gain last year. But then if you scroll down here, you can see this capex. This is the story here, folks. That capital spending that is increasing every single year. It's expected to hit $700 billion this year. Okay. A hyperscaler compute capacity doubling over the next 2 years, says Wells Fargo, says is set to double to 98 gigawatts by 2027. Okay, gigawatts, a measurement of how much energy these data centers are able to put out. It's kind of the measurement of how the growth and the scale of these data centers, growing to 98 gigawatts by 2027. Estimates capacity reached 49 gigawatts at the end of last year. Okay, that's Amazon, Alphabet, Microsoft, accounting for 39 gigawatts. So you see the scale of these hyperscalers, those cloud service providers. 39 gigawatts out of that 49 gigawatts total. So about 80% of that. And you can see if we go back here, you can see how much they're spending to keep up that increase. Okay, here with Wells Fargo saying that is just going to keep on increasing. $700 billion this year, another $800 billion in spending next year. Total spending of $2.5 trillion over 2026 to 2028. Now, we've been following the semiconductor AI supply chain, not just semiconductors here, but a lot of the supply chain to these data centers, this AI supply chain. What you want to look for in a lot of these companies, that are involved in this, that supply the components into this AI data center boom, $2.5 trillion over the next couple of years. Here in the accelerators, we've got Broadcom, we've got Marvell Technology, is going to be looking at both of those next. We've got in the memory companies, memory, huge supply demand imbalance right now. Micron shares, SK Hynix, Samsung, a lot of those memory makers, SanDisk, have almost tripled just over the last year, 400% increase or return on those shares. I think that's a little bit heated right now. That's a very hot trade that I wouldn't want to be chasing too much, but you've still got very good value in these accelerators. You've got the GPUs, the CPU chips. So NVIDIA, AMD, still very much a very good value in those. And then in the server manufacturers, Broadcom here, you can see up 67% over the last year, but a lot of these stocks really flat since September, come down from the highs of last year. It was a high of about $420 per share, now down to $315 per share. So about 25% lower on that. But if we look at the analysis, the forecast for growth on this stock, you can see where the value is coming from. Revenue expected up 53% this year, up 39% next year. And what we want to do with a lot of these, the problem is, again, just like those cybersecurity stocks, they're spending so much of their revenue in research and development, in operating costs, that there's nothing left for earnings growth. Okay. But what we want to do, we want to find companies that are not only growing their revenue, but also growing their earnings. Okay. Able to use that competitive advantage that they have to grow earnings just as fast as they grow revenue. So if we come here, we've got 53% revenue growth expected for shares of AVGO for Broadcom. If we come down here to the earnings estimates, $10.33 expected to be reported this year in earnings per share. That's divided by 6.82 last year. 51% earnings growth expected. So here you've got a company that is not only growing its revenue by 53% a year, but is able to turn that into 51% earnings growth as well, growing earnings just as fast as it grows revenue. That is a real clue into the company's strategic advantages over its peers, that it's able to get that pricing power and the and lower operating expenses to be able to not only grow revenue, but also grow its earnings that fast. We're going to see that same theme there in Marvell Technology, ticker MRVL, but at a much better valuation here. Shares actually down at almost 10% over the last year, down from almost $100 a share down to $77 right now. So again, about a 25% downside on the shares since their peak late last year. But if we go here to the revenue and earnings estimates, we see the same thing. 41% revenue growth expected for this year. So not quite as good as Broadcom. I don't think Marvell has nearly as many components into an AI data center that is really helping Broadcom. Broadcom, not only do you have the accelerators, the GPUs, the TPUs, the things that they're selling into those data centers, they also have the networking, the networking hardware and software that they're able to cross-sell for a lot of these. But Marvell here, 42%, very respectable revenue growth. And here, $2.83 expected to report earnings per share this year, $1.57 last year. That is 80% earnings growth. Okay, so here you've got a company not only growing its revenue by a very respectable 42%, but able to leverage that up to 80% earnings growth. But then if you're talking about valuation, you got to go with Super Microcomputer, ticker SMCI, down 15% over the last year. Now, folks, this is an extremely volatile stock. Okay, we've been in it for the last couple of years. We've seen it go all the way from down $18 per share a couple of years ago, all the way up to $60, back down to $40, $30, back up to $60. If you cannot stomach this roller coaster in shares of SMCI, I don't care how cheap it is, do not buy this stock because it is a roller coaster. But I do believe it's going to be back up to $40, $50 a share over this next year. Going to be one of the best return stocks you're going to have. Because if you look at here, it is the server manufacturer for those AI data centers. $2.5 trillion going into that data center build out over the next couple of years here, and SMCI is going to get a big share of that. Here you see 87% revenue growth expected this year to $41 billion. That was just confirmed by the company just over the last couple of weeks when it reported earnings. Now you do have a little bit weaker earnings growth here with this company. This is the big problem with a lot of these AI stocks, a lot of the cybersecurity stocks. They're spending so much money in research and development, in marketing, in advertising, operating costs, that they're not getting much earnings growth out of it. So we do see here $2.24 in earnings expected this year, divided by 2.06 last year. That is earnings growth of just 9%, okay, versus 87% revenue growth. So it is eating into some of that revenue growth and not being able to leverage that up. But still, 87% revenue growth. All they have to do is pull the trigger, raise some of those prices a little bit, cut down on some of their operating costs, and you're going to see this earnings explode. Here you've got $2.96 next year expected earnings. So we've got going from 9% earnings growth to $2.96 divided by $2.24 this year to 32% earnings growth. Okay, so if we do see anything like that, if we see anything like 32% earnings growth over this next year here for SMCI, you're going to see these shares take off because the valuation here is extremely low. Don't stop with that though. Click on the video to the right to see all the stocks in my 2026 playlist, the top stocks I'm buying this year. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.